JP Morgan has recently updated emerging market equities from neutral to overweight. This is a positive outlook for India with the easing of US-China trade tensions and a weaker US dollar. Speaking of the US dollar, Indian remittances have doubled since 2010-11 to approximately 118 billion, nearly 28% of which comes from the US. The US remittances are likely to be affected going forward with the US government planning a tax on remittances. GCC, which includes UAE and others, makes up for about 38% of the remittances, which is down from 47% in 16-17. UK share of remittances to India has risen over 10% from 3.4% in 16-17. Maharashtra and Kerala continue to be the top states for remittances, followed by Tamil Nadu, Telangana, and Karnataka. Looking at the Indian economy, FIIs are back to being net buyers of Indian equities in March and April, albeit cautiously, after having been net sellers since October 24. Mutual fund SIP contributions have sustained despite the FII sell-off, contributing upwards of 25,000 crores a month, which indicates positivity and investor confidence. The markets will continue to be volatile with the 10-day tariff pause coming to an end in June. The markets were volatile through the terrorist attack, war, and ceasefire, but it's too early to predict stability as global tensions remain unabated. We are seeing positivity in these sectors. The underperforming sectors were these. Retail, however, is an outlier as the underperformance may be due to the gradual shift of consumer preference from public listed entities to unlisted entities. However, it's still quite early as a few companies still haven't reported their earnings. RBI conducted its first OMO, Open Market Operations auction for FY26, but bought fewer bonds than announced, indicating a satisfaction with its liquidity levels. Plus, its 1.25 lakh crore liquidity infusion in May is helping drive down bond yields, making Indian debt markets more attractive globally. While domestic fundamentals are improving thanks to resilient SIP flows and select sectoral strength, global uncertainty and geopolitical risks continue to cast a shadow. Stay informed, stay invested, but stay cautious. Save, invest, and prosper.